Hi everyone, and thank you for joining us again for part 3 of the signal tester tutorials that we're doing here. Obviously there's been a lot of material to go over, and this time what we want to do is just jump through a couple of tests and sort of show you the process, but obviously a lot faster. So if this is the first one that first webinar that you've joined us for, make sure you go check out the other two because they'll set a lot of the groundwork. So what I really want to do today is sort of try and tie back a few of the other concepts that we talked about in the webinars. So we're going to do a test on the risk-reward ratio as we discussed with Kirk Northington, and the volatility-based analysis. We're going to do one with RRGs. And I also want to sort of show you, yesterday I wrote a blog post which will be coming out in the next day or so on the January barometer. And I want to show you how I use the signal tester to create those results and how we can use it for, really the idea here is that there are so many things that as technical analysts we take at face value because that's what we've learned, that's what we've been taught. The January barometer, for instance, is such that what happens in January on the index gives you an idea of what's going to happen for the rest of the year. And so we really wanted to explore that on a quantitative basis and say, well, does that make sense? And so I'll show you how we did all of that as well. As always, first thing we're going to do is we want to look at the condition on the chart. So if we come straight into the charts here, I'm going to move fairly quickly on all of this time. So remember the VBSR tool we talked about with Kirk Northington? We've got the tool here, and the whole point here is that we've got these zones of support and resistance. Now, my risk is always going to be from where I am, where the close is, how far away is my expected resistance. That's what I can calculate as my my risk, because if I was going to be putting a stop there, that would be a great place for it. My expected reward is the distance from where I am now, or where the close is, up into where I expect to find resistance. And so that becomes a really nice measure. And so what we can do, again, we're going to go to our show bar because we want to create a script which is going to give us the information. Now, in Optuma, when you've got the VBSR group, we've got this function which is risk-reward ratio, and we want to bring in the risk-reward number. Now, that's a value which, remember, risk and reward are values of ATRs. So how many ATRs? Fantastic thing that they've done, Kirk and Carson, with this, is that because it's using ATRs, it becomes this consistent measure that I can take from security to security. So that's why it's so good. But what I can say is, I want to know anytime the risk-reward value crosses above 5. So this is dividing one by the other. And a value of 5 may be a good signal that we can use. Now let's make our arrows a lot bigger there. And so I'm looking at that and I'm saying, okay, we've got some fairly decent, there seem to be some down moves there, nice move there. So again, the first step, I'm observing the chart and looking to see whether this is something that I think will make sense for me in testing further. Now, one of the things I remember is that Kirk mentioned when he was here that he would ignore these type of ratios if the trend had been down. So if he was seeing the zones getting posted lower and lower, then he would ignore them. So maybe we can bake that into our script as well. So let's come in here, going to jump in, and I'm just going to call that R1. So again, I'm just putting it in a variable, so I can have a couple of different conditions. And what I'm going to use for determining trend is the Optex bands. Now, Optex bands is a tool that we created and we released in Market Analyst 8 or Optuma 1. Everybody should have it in their copy of Optuma. Basically, it works on the dynamic market profile concept. and creates this again, using ATRs and market profiles and all of that type of stuff to create a really nice mean reversion tool. But as part of it, we also created a trend indicator to sort of say, okay, well, is the trend up or down based on the point of control? I'm going to talk about Optex bands in a future webinar, so don't worry too much about that. But for now, what we're going to do is say we want the Optex bands, and I want the trend. So I want to know when the trend is equal to 1. That's just telling me that the trend is up. And so what I can say now is that my condition is going to be R1 and O1. And so we've got those two there. Let's apply that. And now we've filtered out some of our results. We're sitting there in uptrend. It's looking better. Yeah, some nice ones there. The other thing I'm looking at immediately is when I see multiple arrows, you know, what I know is going to happen is the signal tester is going to take each one of those and measure 21 days or whatever time frame I say from each of those arrows. And I look at this and I say, okay, well, there's a clustering of signals. That may not be the best thing for what I want to do here. So, you know, I'm looking here, and if I just zoom in, I can see that the index there at the bottom position, 69.28, and there, 69.38. So we've got about 10 bars in between. What I might do is I might tell the script that I don't want to have any repeats going on here. So let's come back into our script again. And this time, I'm just going to put all of this in a variable. I'm just going to call it V1 and put a semicolon on the end of that. And now I'm going to say no repeat on V1, and it's for, let's just make it 20 bars. I don't want to have repeated signals going on here. And so I apply that, and now that looks a lot better. I've got some nice signals that I think I can work with. So again, like we did last time, we're going to jump in here. I'm going to save this script, save it as risk return ratio with trend, and hit OK to that. Hit cancel, and we can jump into our signal tester. Now I'm going to grab one of our tests that we did before. I think I accidentally deleted all the ones. So let me grab this one. I'm just going to clone this. And hang on, let me click on that again and clone. There we go. And I'm going to call this one RRR with trend. And my date range is a little bit different. I know this is again a 8-year period where the end is at the start. I don't want to take time changing all of that now. We're talking about the S&P 500 stocks, using the SPX as our benchmark. So let's go in here and change our swing, and we called that trend. And okay, so I had 2 copies of that. Let's grab the one we just used, hit apply to that. And with this one, because I know that risk return, reward ratios, etc. It's not a long-term trend. I'm not trying to capture something over a year. I just want to do this over a month and see how we go. So again, we're going to put 21 in here, and then we'll hit test signal and let that run. Now, VBSR is an extremely complicated function. And so, as I said, I think we mentioned in the presentation with Kirk that, you know, when most tools are about take this much space on the screen, VBSR would go from floor to ceiling. It is so complicated. Having said that, you know, we're already a quarter of the way through, and I know the second half goes a lot faster. So we're probably halfway through our S&P 500 stocks, processing all of those. This may have been one of those cases where I should have said, here's one that we prepared earlier. So jumping along. But again, you know, when you think about the process that this would take any other way, you know, what most quantitative analysts have to go through. As I said, you know, I was told by a quantitative analyst that this whole process would take upwards of 10 hours. You know, the one who was telling me about his experiences, he would set it to run at night and then often wake up in the middle of the night to go and check on the computer to make sure that it was still running and it was still doing exactly what he thought it should do. Then he'd be collating those results and working it all out to get a result, only perhaps to find that the result wasn't quite what he was after, and then having to go and do all of that again. All right, we're getting closer, 43%. So as I said, the first half is the calculation of the tools. So we'll let that continue going. Just while that's finishing off, this is going to be the last webinar for the year. Wanted to thank you so much for joining us or watching these afterwards if you're watching the videos. And we've got so many webinars planned for next year. So we'll probably start in the second week of January. So we'll look forward to that. Here we go. Here's our result. So you can see coming into this, you know, have a look at the drop into the market. Remember, the green line is our signal. We kind of expect that. You know, we're trying to pick up a situation where the distance to reward is much bigger than the distance to risk. So we're expecting to be picking this up on a downtrend. And so we see here some of our key numbers, virtually a 60% probability of gain. And I've got to say, in all the work that I've done with Signal Tester, 60% is phenomenal. You know, that is a really good strategy. And so that looks great. Mean return of 2% in a month that's pretty good. So if we go back to our Monte Carlo to see, okay, let's just give a rough guess of over the year, and let's do 12 tests in that. What we've got there is a 72% gain, probability of gain for the year, with a 25% mean return or a 20% median return. So remember, the difference, getting a little bit tongue-tied there, between the mean and the median is telling us that there's some outliers which are pushing our results up, but still a 20% return on this strategy in what was otherwise a flat market is actually really positive. Good risk to reward, not quite 2 to 1, but getting right up there. So that's one test. This would be something that I'd be saying, yes, I like the idea of this one. Now let me go put that into a daily scan so I can capture any stocks that are meeting that criteria. All right, so let's now jump in and do another one. This time what I want to do is a test on, let me just delete these. I want to do a test on the RRGs. I'm going to do just a little trick there. Just right-clicking on the background lets me choose any sort of chart that I want to put in. So relative rotation graph, let's just grab the S&P 500. This is the end of day data. So double click on that and that'll bring all of those in. Long tails, but that's fine. We'll bring that back and shorten those tails. So what I'm looking for here, you know, if you've read the research papers that I've written on RRG, you'll know that one of the conditions that we found is that when the arrows are pointing to the northeast is when we are outperforming on a relative basis, and outperforming on a relative basis actually does lead to absolute returns. You know, and I know that when the benchmark is going down, you know, any stock that's going down slower is outperforming, but nevertheless, on balance, it does lead to positive returns. And there's a few things we can do again with trend to deal with that. So let's have a look at this. Again, I just want to shorten those arrows for you. The other thing we found in that research paper was that the best results came in the lagging quadrant. So picking up those stocks that everybody else has been discarding and beating down, and finding them when they cross. You know, these arrows here cross and start pointing towards the northeast. So fortunately, now let me just do it this way. I just want to change the colors of this chart to be the quadrant bars. Let's just make those lines a little bit wider. So I can see, now this has given me a representation of where this stock would sit on the RRG. So it just helps me as I'm doing this. So again, I'm going to go to our show bar. I'm going to come in here. I've already got this one set up. So what I'm doing here is I'm doing a JDKRS, which gives me my, my function there. I want the heading to cross above 45. I want to be in quadrant 2. Now the quadrants start at 0, so leading is 0, weakening is 1, lagging is 2, and improving is 3. So I want to be in quadrant 2. And I've also got a distance in there. You know, again, we talked about in the RRGs that when you're further away from the center of the RRG, you've got more potential to get alpha over the benchmark. So, you know, we put in that, that extra distance calculation to make sure that we're picking up the ones that are further on the outside. And then the last line here, I'm just saying that I want condition 1, condition 2, and condition 3 all to be true. So let's hit apply to that. And let's make our arrows bigger so that we see them. There they are there. Again, we've got a bit of a repeat here, but I might just leave that one for now. And so we can see that. So we're in the lagging quadrant. It's going down, but obviously at this time, if we were to quickly throw on the, let's just do an overlay and let's just do SPX for the world indices. You can see here that there was a spike down. So as much as Microsoft was going down, the S&P 500 was going down faster, which gave it that, that signal. So again, let's take this into the signal tester and let's see what we've got. So we go signal tester. I'm going to leave this set up. I'm just going to reuse this test. Normally I wouldn't do that. I'd create a new one. But I just want to make sure that I'm comparing apples with apples. So using the same period, etc. So I already had that saved. So let's go RRG crosses 45, hit apply to that and run that. Now, hopefully this will be a lot faster. Yeah. So the RRG calculation, as while it's quite complex in its normalization, it is still a lot faster than the VBSR and the Optex band combination that we had there before. All right, so putting that all together. All right, so what we've got here is, again, you know, we've got 5,500 results in that period. We're running 21 days. We're seeing nice lift, even probably better lift actually than our previous one. So we're running over 2%, 1.95, we're running 26. The median on the Monte Carlo is a little bit low, so I'd probably want to do a bit of investigation into that one. Reward to risk, again, not quite 2 to 1, but still good. So what I'm seeing here is a strategy using a relative concept, but applying it to absolute terms, which is actually, again, not too shabby. It's giving a nice return based on that. And actually interesting, since I did the RRG webinar a couple of weeks back, I've had 2 different portfolio managers mention to me that they've adopted that strategy of balancing their portfolios based on picking up equities that are relatively underperforming but starting to show strength in the direction of the arrows. And you know, both of them were saying how much difference it's made and their capture ratios are better. And you know, for us, this is what we live for. You know, we want to create software tools that help people, and that's exactly what we are trying to do there. Again, one thing I know though is that, you know, we've got a lot of results there over, what's that, 8 years, 5,500 results. So we're talking about 600-700 results per year, which means that I'm taking 2 trades a day. Now that may be okay, it may not be. Maybe what I can do is be a little bit more selective. And again, we could add trend in. And so I'll leave that as an exercise for you to play with, but trying out, well, what if you added Optex bands, the Optex trend line equal to 1, what does that do to your results if you wait for the trend there to be heading up? Now, remember that last thing that I mentioned, the last one that I want to get through in today's webinar is this whole idea of the January barometer. So let's go to a new page, and I want to do the Dow Jones and bring that up. So the whole concept of the January barometer is that we're told that if what happens in January, so if January is an up month, then we'd expect the year to be a up year. Or if it's a down month, then the year will be a down year. Well, again, we want to quantitatively test that. And the way we set that up is a little bit different, which is why I want to show you this example. As always, first port of call is the show bar. I've got to make sure that I'm writing this script correctly because they are interesting. Now, I'm trying to see whether I actually, no, I didn't save it. All right, so what I need to do is, we have a number of scripts which just talk about the month numbers. So what I want my signal to be is not on January, but on the beginning of February. So I want to say, I want to have a look at monthly data, and I want to know that the month number has changed to February. So let's do it this way. We're going to do M1. First of all, even though I'm looking at a daily chart with all of this, I want to actually do my calculations on the monthly data. So I'm going to just do, let's do month. And that's putting now, it's taking the daily prices, converting it into monthly, and putting that into M1 for me. And so now what I can do is say, what I want to know is that, let me do this quickly. I need to do I'm doing the square brackets 1 to say that I want the previous value. So I want to know that the previous value of the monthly data was up. So I'm going to do is up. And I'm going to put all of that in parentheses because that's the first condition I want to test on. And then after that, we want to say and open and close parentheses. Actually, let me just get rid of those for the moment. Month number changes to the number 2 for February. So I'm saying that the previous month has to be up and the month number changes to February. So let's just apply that one, and let's increase the size of our arrows. Just make sure that we've got, where is our arrow? Here it is. So we're at 1st of February is our signal. Perfect. And that January was up. That January 2005, we didn't get a signal, but we can see that January was a down month in 2005. So our signal's working the way we'd expect. Again, you can either copy it or you save it. You know, I might just save this script as and call it Jan Barometer and hit OK to that. So now let's go to our signal test and set up a test on the Dow Jones. The reality of the January barometer is that it just talks about the indices. So, you know, we can do the test on all the stocks, and I do that in the blog post, so look out for that, and you can have a look at what's going on there. But let's just go and create a new item here. We're going to call this one Jan Barometer. And this time, I'm just going to do this on a single code. You know, every other time we've done it on multiple codes, but this is a case where I just want to do it on the Dow Jones index file, and I want to do that on everything using daily data. Given that this test, or the theory of the barometer, says that whatever happens in January goes on for the rest of the year. We need to extend out. The 21 days isn't going to be right. Now there's 252 days in a year, so if we take 1 month off that to add 11 months, we're going to get 231. So we're going to go forward 231 trading days when we get our signal. I'm going to turn the bands off, don't want that on, and I'm just going to leave everything else as it stands. I'm not having a comparison index in this case. I just want that. Now I need to get my script. So let's go to January Barometer and apply that and test the signal. As you can imagine, it's very fast. What I'm seeing here is that when January is up, we have a 70% probability of gain. So that's telling me that when January's up, I've got 70% likelihood that the year is going to finish up. And in this case, it's finishing up mean of 7%, median of 8.9. So, you know, we're in that range of 7 to 8% for the 11 months from February 1 to December 31. Reward to risk of nearly 4 to 1, or probably 3 to 1's closer, so 3.5 to 1. So, you know, that's really nice. So as we come into the new year and as we come to January, keep an eye out on that. Now, of course, we should do the opposite test. We should change our script to is down, but I'm going to save that for the blog. Otherwise, you're not going to read my blog post. So I'm going to let you find out, either do this for yourself and find out the results, or go and read my blog when it comes out in the next day or so, and find out for yourself how that one went there. So there are a couple examples of the signal tester. You know, again, it's really there to help. It's really the goal that I've been trying to do. You know, so particularly for me, I still have I'm kind of torn between my love of quantitative analysis and my love of GAN-based analysis. And so one of my goals over the next few years is to find ways that we can quantitatively test a lot of GAN techniques. And so, you know, I just love this. I love thinking about, okay, well, what is something that we take as an accepted truth, and how can I put rules around that? How can I test whether that's right? You know, it may be in your case, it may be, well, what is the scenario that you've been using to either rate a equity as a buy or add something to your portfolio? Put it in, you know, and again, if you need help with scripting ideas, please do let us know. And we look forward to talking to you then. Thank you so much. So again, thank you so much for watching. We wish everybody a Merry Christmas, Happy New Year, and we look forward to continuing all of these webinars in the new year. Our support is running on skeleton support over the next week and a half, but all hands are back on deck in the first week of January.